Hello, welcome to Future View. It is November, which is just pure craziness. Welcoming my friend Andy. Andy, I was on the road traveling last week, but I know there were some changes and some notifications from the Fed. I had people texting me saying, did my rate go down? Did my rate go down? And the answer was, not really. So provide some clarity to our listeners on what happened last week, why it happened, and why it didn't do the impact to interest rates people were looking for.
Yeah, and hello, Andrea. It's always good to see you. Yeah, the Federal Reserve communicated late last week, I think it was Thursday, that they were going to cut the federal funds rate by 0.25%. And, whenever the community hears about that, they automatically think about credit cards and car loans and mortgages are all coming down by 0.25%. That's not really how it works. So the Fed funds rate, let's start there. The federal funds rate is a interest rate that the Federal Reserve sets for banks to borrow money from the Fed or even borrow money from each other overnight so that they meet their minimum depository requirements as banks, right? So it's not a direct impact on consumers for any money that you have out there. Probably the most direct impact the Federal Reserve has of cutting interest rates by a quarter is if you have a home equity line of credit that's on an adjustable rate mortgage, or let's just say you have an adjustable rate mortgage. Home equity lines of credit, the most common adjustable rate mortgage in our business. So yes, you will experience a 0.25% interest rate reduction on your home equity line of credit. But for first mortgages that are fixed rates, or you're thinking about buying a home and you're getting rate quotes from loan officers right now, it's not directly tied to the federal funds rate. Here's why. Mortgages are more directly tied to a longer term, similar type of loan, right? Because if you have to think about mortgages, there's people that borrow money, and then there's investors that invest in those loans that are written on homes for mortgages. The investors are trying to figure out what kind of rate of return do they want on their money from those that are borrowing to buy homes. And the most consistent thing it's compared to is the 10-year U.S. Treasury note. And the 10-year U.S. Treasury note is guaranteed by the full backing of the U.S. federal government. You can borrow money from the federal government. They return it back to you in 10 years and you're an interest off of it. Or you can let homeowners borrow your money through mortgage-backed securities, and they pay the interest on their mortgages. And typically, the average homeowner doesn't hold their mortgage for 10 years. Usually, it's somewhere around 7 to 10 years because either they sell their house or they refinance it or pay it off. And that's why it's so likely compared to a 10-year U.S. Treasury note instead of a 30-year U.S. Treasury note, since most mortgages are 30-year fixed-rate mortgages. So the 10-year Treasury trades every single day. There's new issues every week, and there's a lot of investors that look to buy really safe interest-bearing investments like that. And what the 10-year Treasury moved up within an hour of the federal funds cutting in the Fed funds rate by 0.25 point, the U.S. Treasury note started to trade up. More people were, let me think about this. There was more demand for the U.S. Treasury. The supply was the same, therefore the yield on the U.S. Treasury started to go up in the open market. Why? The reason why is when the Federal Reserve makes an interest rate decision, they also issue comments, public comments about the decision they made, and and a lot of those comments can be forward-looking. And in general, economists in the United States have kind of baked in or been communicating to the public and investors that they expect 3 rate cuts this year. The first one that happened in September, the second one that just happened last week, and then they expected a 3rd rate cut in December. That's kind of baked in to where people are trading U.S. Treasuries right now. And when they communicated the Fed funds rate cut last week, they said there is no guarantee of a 3rd rate cut this year. And part of the reason they can't guarantee that there will be a 3rd rate cut is because there's a lack of economic data right now while the government's shut down, and they still want to see continued data that supports the fact that the labor market's softening a little bit, right? The reason they want to bring interest rates down on the Fed funds rate is because they want to open up the supply of money And they really only want to open up the supply of money because the economy needs it. We've been dealing with some sticky inflation for the last few years. Inflation hasn't really made the case to drop interest rates, but the labor markets have been making the case. Less jobs have been created in the last 6-9 months than were expected. There's been some recent layoff trends from corporations, and that's the Federal Reserve going, okay, there is, the labor market's not as hot as we thought. There's probably room to bring down the cost of borrowing money, and let's spread that supply of money out into the market. Make sense?
It does, actually. It brings a lot of clarity to what happened. I'm can't wait to send this to all the folks texting me last week to provide that for them, because you broke it down a lot better than I did, I'm sure. That's awesome.
So when we're talking about this is what the 10-year Treasury yield has looked like just the last 5 days. So hopefully you can see my little cursor here. Mm-hmm. This is when the Fed decided to cut interest rates, but also put the comment in there that they may not make the Fed the rate cut in December. And so this is where people go, okay, they may not make that rate cut in December. We need to recalculate our expectations. And that's where the trades caused the yield to go up a little bit. But let me put this in just a larger kind of view. This is the 10-year Treasury looking at it for an entire year. And this is where you really want to see the forest through the trees. Interest rates have gone through a very big improvement just in the last 12 months. We saw a high of the 10-year Treasury about 4.7%. The 10-year Treasury, this is the little blip up since the decision was made, but we're still about almost 3/4 better in yield on the 10-year Treasury, which mortgage interest rates have improved by more than 3/4 in the last year. They don't directly follow the Treasury. They're compared investments to each other, and the spread between mortgage rates in the secondary market and U.S. Treasury have narrowed. People don't look at mortgage-backed securities as that much riskier than the 10-year Treasury. So therefore, we're kind of seeing a really, really good improvement in mortgage rates. So I share that to say the bigger message right now is it's a good time to buy, right? We're in the slow market. Inventory's up. Demand's going to be down a little bit just because there is a natural cycle to housing demand, right? And when you get into the fourth quarter and first quarter of each calendar year, people are a little bit busier with other things like traveling for holidays. Kids are in school. They're buckled down at work. There's less people out shopping in the housing market. So if you are truly looking to move or buy, you have a great opportunity right now because inventory looks very, very healthy. Mortgage rates are still very good comparatively to what they've been for the last few years. And there's a lot of really good new programs out there for mortgages that can help solve some complicated financial situations that people get themselves into.
Thank you so much for giving us that information. Can I ask you another question while I got you?
Let's do it.
So we are known as an industry for being a little acronym heavy. So you're going to have to explain to our listeners what this means. But there is talk that we will be potentially getting rid of LLPA rate adjustments in the future. Is this happening? Is this just smoke, or what's the story?
Yeah, so now we're going to get into a little bit more technical things about mortgages and interest rates. There were some headlines in the last couple of weeks that Bill Pulte, the new director of Federal Housing and Finance Authority, along with really reestablishing the boards of Fannie Mae and Freddie Mac, that he has a lot of interest in. Fannie and Freddie are both reviewing potential removal of what are called LLPAs. It's 4 letters, LLPA, loan level price adjustment. What a loan level price adjustment is, and this is what creates a lot of confusion for consumers, right? Like you'll look online and say, oh, look, the 30-year fixed rate mortgage is at 6.19% today. Mm-hmm. Not everybody's going to get that interest rate quote, right? So that interest rate quote is very specific to a scenario. It's maybe it's a purchase of a primary home. Person's going to put down 20% down payment. Their credit score is over 740. It's a single family detached home, and it's located in, let's say, the state of Florida. Everything I just mentioned there are key characteristics of that loan application: the amount of money being put down, the borrower's credit score, the type of home it might be, whether it's condo or single family home, the occupancy, it's going to be their primary home. All of those potentially drive loan level price adjustments. And let me bring this back up. This might even provide a little bit more clarity, right? This is public knowledge. You can look at an LLPA matrix. This is Fannie Mae's matrix, and I'll just look at the very first page here. Here's just one simple example of an LLPA matrix that is evaluating the client's credit score on the x-axis and is evaluating what the loan amount they're applying for compared to the purchase price of the home. We call that loan to value, the percentage of the home price that they need to borrow. So, one quick example, if I just look right here in this block, if somebody's looking to borrow up above 90%, up to 95% on the purchase of a primary home, and their credit score is between 700 and 719, there's going to be a 1.125% fee applied to the pricing on this loan application. And that fee is applied to the loan amount. You may never see it. Loan officers don't usually go into detail about LLPAs. What they end up quoting to you is what's the net interest rate and cost for the mortgage, and this will just be embedded into all of it. And you can see there's all kinds of different cells. I'll also show you these LLPAs are pages long, right? And the whole idea of LLPAs was to create pricing differentiation based on the risk of a mortgage. Like if you're buying your home you're going to live in, and it's going to be a single family home, and you're going to put 20% down, we want to reward that borrower for being a less risky borrower, especially if they got a great credit score, maybe above 740. We want to reward that borrower and provide them better pricing on that loan, as opposed to maybe somebody buying an investment property, putting the minimum down, and maybe they don't have the best credit. Maybe they've missed some payments on something, and they have a 660 credit or something. Right. In that case, we're not going to reward that client for the risk level. We're going to appropriately apply the pricing to the risk level. So the point is Bill Pulte's come out and said we might remove these LLPAs. It could be a good thing in the fact that it makes things simple for everybody to understand. And if you see an interest rate on a website, you can potentially have a closer mindset of like, that's probably going to be the interest rate I need to
right.
be prepared for. I don't know that it's going to be good for everybody, right? Like, honestly, if you're somebody that really protects your credit very well and you feel like you're a low risk borrower in a transaction, you have advantages to the LLPAs right now. And if without those advantages, that risk cost has got to be put somewhere, and that might be spread across everybody instead of being specific.
That's really interesting. Is there like a timeline, or that anything that's being said is when the decision is going to be made?
No, there's no timeline on it. I think it was just a message of, this, we're looking at this, and this is something we might remove. I think a lot of people got excited about that. Barry Habib is one of the most renowned economists. I don't know if the economist is the right word, but forecaster in, the mortgage market and what to expect and forecast for your business. He's excited about this. He's advocating for this, and Barry is a much smarter person than I am, and maybe there's some advantages to that he sees that I don't. But I think his general message is, I think the removal of LLPAs could bring the cost of borrowing money on mortgages down overall, and I don't quite get that, but that's the message from somebody smarter than me.
That is really interesting, because you're right. You would reward the person that has that super high credit score and buying their first home and things like that. So that'll be interesting how that shakes out.
Yeah. I mean, the bottom line, though, this all goes back to the same bottom line, right? Like if you're thinking about buying a home, you already have a home, you're thinking about refinancing, you've got questions like this. The whole point of our company, Future Home Loans, the whole point of, our vision and how we add value to our communities is through education. So we never want anybody to worry about, asking us any question at all. Maybe you think it's a stupid question. There are definitely no stupid questions in mortgage. And if you're not sure where the starting point is, just email help@future.loans and throw a question in there, and we'll get a hold of you, and we'll have a ton of patience and a ton of time to give to you to make sure you have what you need.
Awesome. Thank you so much for joining me today, Andy. It's always a treat. Have a wonderful rest of your week.
You too, Andrea. See you later.
Bye-bye.